Welcome to Boots on the Ground Oil and Gas. It is July 26, 2017. This is episode 1, the Venezuela economic crisis. So for those of you that haven't been keeping up with the current events, I'll just give you a brief rundown of what's going on in that Latin American country. In Venezuela, currently there's a severe economic and political storm occurring where the near dictatorship government is suffering from hyperinflation, large debt burdens in the billions, and a reduced supply of crude oil available to sell on the open market. Additionally, the country's people are hungry, suffering from the hyperinflation, and not being well represented by their government. So, on average, Venezuela ships about 850,000 barrels of oil per day to the Gulf Coast of the United States, where there are major refinery facilities in Texas and Louisiana. And for those of you that don't know, refineries convert that crude oil into gasoline, diesel fuel, jet fuel, refined oil, heating oil, and chemical feedstocks, which is used for the manufacture of plastics and other synthetic materials. It's used for pharmaceuticals and cosmetics, among other things. So, recently, the U.S. government has threatened Venezuela with some form of economic sanctions against the PDVSA, which in a nutshell is just the state-owned oil company. The sanctions would be in response to the Venezuelan government's handling of the social and economic unrest. So those of you that have been keeping up with CNN or Fox News or whoever you get your news from will know that the government has taken somewhat of a heavy-handed approach towards the people protesting and the ones offering resistance to the government. So the worst case scenario, being that there are many options available in the sanctions, would be for the U.S. government to abruptly ban those shipments of oil to the U.S. Gulf Coast. Now, this is especially damaging to the Venezuelan government if it occurred, because that country depends on oil revenue for 40 to 70% of its revenue, which pays for the operation of the government, pays for the programs and special services, so that would be a significant blow to them, given that they are already under a lot of economic strain. In addition to that, Venezuela has a oil-backed loan outstanding from China, where they're required to make oil deliveries to China as part of the terms of that loan package. So, in order to keep the loan in good standing, Venezuela is required to send oil shipments to China, which reduces their available crude to sell on the open market, meaning to the United States, the Gulf Coast. So, if the worst case scenario does occur, many of the refineries in the Gulf Coast, including Valero, BP, Marathon, Citgo, would have to obtain their oil supply from somewhere else. This would hit Citgo the hardest, as it is a wholly owned subsidiary of the Venezuelan state oil company. So that would be another loss piled onto their existing problems. So many of these refineries would have to try and look elsewhere in the open market for that particular type of crude oil. So, but you may be asking yourself, well, isn't there a global oil oversupply currently? Isn't that what's been all over the news? And the answer is yes, there is an oversupply of oil throughout the world. But refineries are adjusted to maximize efficiencies within their operations for a specific type of crude oil. So crude oil is not the same throughout the world. There are different types. The type that comes from Venezuela is called heavy crude, and heavy crude refers to a higher sulfur content in the crude, and other crudes have different levels of sulfur. And so what they do, they will blend that heavy crude with a lighter crude to make like I guess you could say a medium blend crude, and then they ship that to the U.S. So the refineries are specifically tuned to run that medium level crude, and that's how they maximize efficiency and they maximize their profit. So in theory, they could run on a different type of oil, but then the efficiency levels go down and the profit margins go down, and no business in the world wants that. So the belief here at Boots on the Ground is that the worst case scenario is unlikely, as it would harm a company that does indeed employ U.S. citizens and would raise the gasoline prices in the Gulf Coast area. Southern parts of Texas and Louisiana, Houston area, New Orleans area, and the other southern states. So your Mississippi, Alabama, Georgia, Florida, even all the way to South Carolina, because those states all feed from the same gasoline pipelines coming from those refinery complexes. So what's our perspective here? How would this scenario affect Boots on the Ground as an oil production company? We would see the worst case scenario as having a short-lived effect, perhaps lasting 4 to 6 weeks, where we would see a modest increase in the price of oil that we sell, which is West Texas Intermediate, also known as WTI. So another question you might be asking, though, at this point, why would the price of WTI go up if the oil supply that's being reduced is a different grade or type of oil? Meaning they're using that medium blend of oil and you're selling something totally different. Okay, fair question. Ultimately, what happens is there is a reduction in gasoline supply derived from the Venezuelan crude, and that pushes gasoline prices up. And other refineries that make gasoline from West Texas Intermediate, or the WTI, they will increase their production of gasoline to capitalize on the higher price and try and put some more money in their pocket. So they will process more West Texas oil and continue to purchase more West Texas oil, and that will put upward pressure on WTI prices, which is what we sell. So the effect to us would be positive, but it would be very modest. And when I say modest, I mean probably single-digit percentages, and maybe last for 1 month. So ultimately, in the big scheme of things, the effect is very little to us, especially considering we are a small oil production company. We're not like Exxon or Apache or Anadarko, who produce hundreds of thousands of barrels within their organization. So it would be a very minor effect to us. The bigger question, though, is how long will the instability in Venezuela last? What will be the final outcome? As you can imagine, there are quite a few scenarios here that could occur, and the path to any one of them is filled with a lot of uncertainty. There could be a case where the president there decides to abdicate and allow someone new to take over. They hold new elections, and there's a whole bag of questions with that. The government could consolidate its power and crush any resistance there and make the country a full dictatorship. And so that's a different direction in the road. So it's hard to say at that point what would happen. But when it comes to the oil markets, don't like uncertainty and instability, especially in a country like Venezuela, has one of the largest oil reserves in the world and is a significant supplier of crude oil to the U.S. and to other countries. So it would have some effect on the global scale if it dragged on for a long time. So that concludes episode 1 of Boots on the Ground Oil and Gas. Please check back with us on a regular basis for new episodes. Thank you.